Good evening, everyone. I'm just letting everyone in from the waiting room. As soon as we are ready, I shall get started. I just want to give those in the waiting room some time to actually log on and to allow people in. We're just letting everyone in. I shall start in a minute or two, if you will just bear with me, please. See, there's still quite a few people busy joining, so just give us a moment, please, while I let everyone in. Okay, we shall begin in just a few seconds. Just a few more people that I'm letting in from the waiting room.
At Holborn Assets, we know that trust is the foundation of any financial partnership. For over 25 years, we have been more than a financial services company. We have been a trusted partner to over 20,000 clients with 26 offices across 18 countries. Our dedication to our clients has earned us a 5-star rating on Trustpilot with over 2,000 glowing reviews. As a fully regulated, multi-award winning company, we are trusted with managing over $2 billion in assets. Our team of fully qualified advisors is committed to providing you with personalized, market-leading financial solutions. Choose Holborn Assets, your trusted partner in wealth management and financial advice. Visit our website or call us today to start your journey towards financial success.
Okay, I think we are ready to start. Welcome, everyone. Thank you for joining me this evening. Let me stop the background so everyone can see me clearly. So the aim of this webinar, in part of my Saving as an Expat in Asia series, in many of the other previous webinars, we've looked at, do you send money home, property back home versus investing abroad? We've looked at all sorts of different things. And now the aim of this one, again, that age-old expat question, someone living abroad, a Safa living abroad, where do I set up my savings investments? Do I set up something back home? Do I keep my money abroad? Are there better options available to me now that I live abroad? And then most importantly, and this is what I will concentrate on today, is that question that everyone asks: what about the costs? So if you will bear with me, that is what I will try and attempt to do today in a user-friendly sort of manner. Please be warned that I will try my best to make the lingo and the jargon simple and try and find an easy way to explain everything, but it is very much a technical sort of field. Now, a little bit about myself so that you know who it is that is presenting to you this afternoon or doing this webinar this evening. My name is Matthew Taron, and I am a senior associate with Holborn Assets. I've lived and worked in numerous countries around the world. I specialize in advising expats or South Africans living abroad and other nationalities living abroad when it comes to investment, wealth management. I am an expert on many of your expat groups as the financial expert. I am qualified in both South Africa and regulating South Africa, having passed the regulatory exams here, but also internationally qualified through the Chartered Institute for Securities and Investments, which is the industry leader when it comes to financial education. Who is Holborn? Holborn is a wealth management company and advisory. We're an independent advisory, and we were founded or started in the late 90s. We're currently the second largest independently owned private financial advisory company. We have several $1 billion in terms of assets under advisement, and we have licenses and offices in over 18 different jurisdictions spanning the globe, coming out on the far end of the world, up from Australia towards Thailand, Hong Kong, Malaysia, Vietnam, coming through Saudi Arabia, Dubai, Mauritius, South Africa, into Europe, Portugal, Cyprus, Spain, the UK, and all the way into the US, managing, as I said earlier, several $1 billion. But I will go through that in more detail individually with clients and people who are interested. What makes us different? Very simply, those 5 pillars that we pride ourselves on: our size, being the second largest independent wealth advisory; our independence, the fact that we are privately owned, so we are not incentivized by any one fund, product provider, or company. We charge homogeneously across the board, so we're able to choose, and I will go through this later in more detail, who we work with based purely on merit to what our clients actually need. Our levels of service, the fact that we win all the international service awards, that's where we pride ourselves. Our education, the fact that every advisor and wealth manager is required to be internationally qualified. And then our safety, the fact that we look for jurisdictions that are safe and secure for our clients with some form of government-backed investor protection or reinsurance type of program. So let's get then to the crux of today. Where do I set up my savings? Back home, or do I keep my money abroad? Now, I'm going to go through this very briefly because the main aim is to go over costs. And I've done quite a few webinars. You're welcome to look for me online on these various matters. The first one being, if we're going to set up our investments, some of the things we need to consider, and I tell this to many clients, is those 3 deadly shins. How do you make your money and your wealth grow? Well, start off by eliminating the 3 things that pull it back, that erode that wealth. While you're trying very hard to make your money grow, these 3 things are trying equally hard to make your wealth and to make your money worth less each and every day. And what are they? Well, it's that taxation, inflation, and currency devaluation or depreciation, as some may call them. And I go through this in quite a bit of detail in many of my webinars, so you're welcome to look them up or simply book an appointment with me. You'll be able to scan my QR code at the end and we can go through it in detail. When you're setting up investments, consider also the geopolitical instability. What are the main reasons why people actually, even South Africans back home, why do they set up their investments abroad? Why do they take their money out of the country? Not only because of those 3 deadly shins, which play a major role, but often it's because of that geopolitical safety. They want to have their money in a much more stable and secure jurisdiction. They don't want, as we've seen with the local recent budget, a government of national unity, which is changing all the time, to suddenly wants to increase VAT or wealth taxes or a change scheme to the proposed changes to taxing collective investment schemes in South Africa. And I'm doing a webinar with one of the country's foremost tax experts on that in a short while. So we want somewhere geopolitically safe. Clients want their money in hard currencies. They don't want it losing value. They want access to global markets. They don't want any of those restrictions when it comes to Regulation 28, the threat of having your pension or retirement savings used towards rescuing out SAA or Eskom. They want to know that they have control over their money. So there are a lot of reasons why people do that. Also, looking at South Africa, let's face it, South Africa at the moment is 0.6%, 0.6% of the global economy. There isn't a single top 100, top 300, or even one in the top 500 global companies that's inside South Africa. But I'm going to take all my money and send it back to South Africa and save it in that little speck of the world, even though I live abroad. And then the other side, accessibility and portability, being able to access my funds abroad, and being able to, as I move from country to country, have that move with me. And then finally, why do people set up their investments abroad rather than South Africa? What are one of the main considerations? Cost. And that is what we are going to focus on today. So before we do that, what is cost? If we're going to compare costs between different companies, let's understand first and foremost what cost actually is. Now, cost, if we look at the dictionary, the Webster-Merriam dictionary or Merriam-Webster dictionary, cost is defined as the amount or the equivalent that you've paid for something. It's an outlay, an expense that you've had to put out to be able to achieve something. Or it's the loss or penalty incurred because of being able to want to gain something. So anything that you use to help you achieve your investment objective is essentially a cost. Now, what are those things? What are those costs that we often come across? What are different costs when it comes to investments and savings? There are many, and I'm sure you won't be surprised to know, but there are many costs associated with savings and investments. There are your administration fees, your policy fees, your contract fees, advice fees, your fund management fees, upfront commissions, ongoing commissions. There's the underlying fund charges. There's performance fees on many investments. There are entry fees, exit fees, trading fees, dealing charges or fees, the actual platform fees. And then there are penalties as well, which are also types of fees. And then there are cancellation fees. So that's quite a large amount of fees, and understanding what all of those are, and many different companies attribute different names to them and different ways of doing them. So it can be quite a nightmare trying to understand and trying to compare the different fees between different companies. Even investment experts out there often have a very difficult time being able to do that. So what I've done is I've gone and I've tried to make it as simple as possible, looking at the most common fees. Now, in South Africa, the way of comparing fees between different companies has been standardized over the last few years, and it's been regulated so that when you are comparing different companies, you're able to put the two together and say, these are the costs for company A, these are the costs for company B. It'd be great if it is honestly that simple. Different companies can do different things within those fees, but it gives you a base to be able to start off with from. And they call that EAC, otherwise known as your effective annual cost. So what is EAC? Now, if we go by the definition of EAC, EAC is a standardized disclosure of methodology that is used by consumers, so people like you and I wanting to purchase investments or products, and advisors to compare the actual charges on most retail investments, so most investments available to the public. It allows you to assess the impact of those fees on those investment returns across various different so the different types of products, whether it's using an endowment or whether it's using a retirement annuity or whether, there are lots of different products available out there. It puts you, the consumer, in a place where you're able to make a better informed decision. So where you can understand things a little easier to be able to compare. So take, for example, comparing apples and oranges. They're very completely different, fruits. They're both fruits, but they're very different. So EAC in a way would be like saying, well, what is the nutritional value? How many kilojoules per, I don't really know much about food. What are the kilojoules? What's the vitamin content or the mineral content? So you can see, well, which one is probably going to be the better one for me. That's what EAC effectively does. The EAC is a measure of the effect of those charges. So how does the charges, the costs, affect my investment? So how does it affect the charges that you will likely incur having that investment and holding that investment? It does not, and this is very important, it does not attempt to measure the features of that product. So it's not going to measure which one is better for you from a tax perspective, which one's going to give you access to more funds, or which one's going to give you a greater global access, or which one's going to give you different types of guarantees. And all it very simply is measuring the costs in terms of both. Now that we know what that is, let's look at an example. And this is an example that most companies will use. So it'll show you the impact of your charges in year 1, in year 3, over the next 5 years, and then over whatever years until maturity, until you reach the very end. And they will break into different proportions or different sections. You'll see the investment management, and that's basically how much it costs to invest in all the underlying funds. What's actually within the engine of that investment? How does that, what are the costs involved there? So it'll look at your, what they call a TER, total expense ratio, and the transaction costs and the reduction in. So again, to try and make things simpler, what is the cost of that engine? Then it'll also have the advice fees. So, and the advice charge is basically all the advice, what the company charges you for the financial advisor or for the salesman or the agent's fees, the commissions. Then you'll have the administration costs, and that is, as it says, that's all the admin costs. And then you have that magical block called other. And other can be all sorts of things. It can be all other fees, how bonuses affect them, how the penalties affect them. And this is where things become a little more sort of, gray, because it's very difficult often to tell what is in there and how that actually affects things. But that is what EAC, it's broken down into those 4 blocks. And you'll see, for example, that in this example, they said that in year 1, if you had an investment in year 1, the effective, how much would it effectively cost you? It would cost you 2.9%. Of the growth of your investment. Over the next 3 years, by year 3, it would cost you also 2.9%. Over the longer term or medium term towards 5 years, it would cost you 2.8%. And over whatever term until it matures, it'll cost you 2.4%. So you'll also find that EAC becomes cheaper and cheaper and cheaper the longer you have that actual investment. That's because they have longer to recoup those fees. They don't have to recoup them all within 1 year or within 2 years. So if we're going to compare South African products with an EAC system, internationally very often used is the reduction in yield system, the way of looking at costs. Now, what is reduction in yield? Reduction in yield also, as was once used in South Africa, is the percentage point reduction in the period of saving. So how much is your investment growth reduced by charges? So essentially very similar to EAC. So for example, an RIY or reduction in yield of 3.5% means that you'll pay on average 3.5% over the term of your investment in terms of that growth. So your growth will be reduced by 3.5%. So how much must your investment grow to cover its charges? So if we compare those two, effective annual charge versus reduction in yield, another way of trying to look at it in very simplified form, EAC is how much the charges will impact your investment's growth. So if you want an investment to grow at 6%, it means I ideally need to make my investment grow at 8%, so I've got 108, minus the 2% EAC, so I've got 6%. So this is assuming EAC is 2%. So how much did the costs eat out of my growth? It ate out 2%. If we look at reduction in yield, it's the exact same thing. How much must your investment grow to cover those charges? Again, so I want 6% growth, and I need to be able to recover another 2% because that's how much it's going to reduce my growth. So I need to have 108% growth to get to my 106. So the reduction is 2%. It reduces my growth from 8% down to 6%. So effectively the same thing, just in a different way of putting it, or in a different set of words. So now let's compare the EAC, or the reduction in yield, between different companies. And that is why we're here. Now, to be able to do this, what I did is I spent quite a lot of time specifically approaching companies and asking them for quotes, and asking them to send me the actual quotes with the illustrations. And I went to quite a large number of companies, and I gave them very specific instructions to be able to make sure that they can be the same across all of them. And I asked for, very simply, I want to be able to put 8,700 Rand or $500 into either an endowment policy, or into one that's taxed, or into a retirement annuity, one that is then gross free of taxes. And I want to do it, I used my own age for a specific term of 15 years. So that way we can get a nice medium to longer term comparison of those, very simply. Now, many of the companies obviously could not do it in dollars. So they did it all in rands, and I've put the results now in rands. I went to Liberty, Discovery, Old Mutual, Allan Gray, Momentum, Sanlam, went to a few others as well. And then I chose to compare that with a company that I use on a very regular basis. I deal with quite a few companies, but one that I most often use for clients in Asia is a company called Hansard. So I've compared it with theirs as a baseline. Now, the EAC, or the reduction in yield, as I got from Liberty, for saving that 8,700 Rand or $500 for the next 15 years, turned out to be just above 3.5%. For Discovery, they came in slightly cheaper at just under 3.5%. Old Mutual came in also just under 3.5%. Allan Gray came in quite a bit cheaper at just over 3%. Momentum came in at just under, or at 3%. Sanlam came in considerably cheaper at or just a little bit over 2.5%. And then Hansard, in terms of the international product, came in as the cheapest at just under the 2.5%, or quite a bit under the 2.5% mark. Now, one might think, look, sort of from 2.5% to 2.7% or 3%, it's 0.5% or 0.6%, or it's 1%. It's not going to break the bank. There's not much to it. And we'll look at later at just how much of a difference that minor percentage plays a role. And this is why costs are so very important, and why, particularly from a South African perspective, clients are very much cost conscious. So on average, I found that your South African companies were around 43% more expensive than just keeping your money abroad and setting it up with a company like Hansard, for example. That's quite a bit more expensive. Very simply ask yourself, if you're going to buy something, are you okay paying 43% more? Then comes the bigger question. Now, for me, one of the major things that one needs to look at is tax. Now, I've assumed here the lowest tax bracket, and I've taken two alternatives. Let's say one, you at the lowest tax bracket, and two, you use an international or use endowment for your own savings and your investments. One is tax at the lowest tax bracket, 18%. The other is tax at a fixed rate of 30%. So how does tax affect it? If we look at tax as a cost, because it's something that you need to pay, you don't have a choice, it gets paid. So effectively, again, what is that definition of a cost? Something that you have to pay or outlay to be able to achieve something. And you're going to have to pay taxes to be able to have that investment. So how does tax affect those costs? So again, very simply, if you remember, Liberty was just over 3.5%. Sanlam was at roughly 2.5%. So how does tax affect that? Now, let's assume you're paying 18% tax. What it means essentially is that the cost of your investments go up. Instead of being that just over 3.5%, with Liberty, it now means it's nearly 5%. Or instead of being just under that or at that 2.5% level, it means it goes up considerably to just under that 4% level. So that tax means that you need to grow. It increases your EAC, or your reduction in yield, by 1.3%. So you need to grow an extra 1.3% to cover those costs, the cost of having to pay tax. That's 105% more expensive than using an international option. What say you were someone where your financial advisor or broker back home put you into a endowment and you're saving your money in dollars, or it's still in rands, but it's an endowment. We're not going to look at currency at this point. Endowments are taxed at a fixed rate of 30%. So what does that make in terms of costs? There you can see the costs literally more than double. You're looking at having to grow an extra 2.6% just to be able to make up the difference of what that tax costs you. Essentially making saving back home 164% more expensive when using an endowment versus saving abroad. That is a major consideration that one needs to think of. Now, you may think that 1.3% or 2.6%, it doesn't make much of a difference. I'm okay with that. So let's look at how that actually affects things. Now, we know South Africa is known as a high tax jurisdiction. Income is taxed up to a rate of 45%. Your shares or equities taxed at a fixed rate of 20%, and capital gains is up to 18%. Endowments, which is why I did that as well, it's an option very often used by local financial advisors, but very few know that endowments are very much only suited to clients in a 45% tax bracket. If you are an expat living abroad, sending your money back home and putting it into a product where you are taxed at a fixed rate of 30%, why would you do that when you're paying much less tax abroad? Or where you can structure your things in such a way not to pay tax. So in an endowment, income is taxed at a fixed rate of 30%, shares still at 20%, and capital gains at 12%, which is why many will tout a endowment to be a tax-efficient option. Now, compare that to something where you don't pay taxes, where you keep your money abroad, you put it into some sort of product where you don't pay taxes. What's the benefit of that? Well, even the most basically educated advisor or wealth manager, or anyone back home, even the banks will tell you that if you're not paying tax, your money grows considerably better. There are distinct benefits to tax-free savings. Whether it's 10x telling you that your money will grow significantly more, whether it's Discovery Bank telling you that tax-free savings is better, whether it's Sun, I'm showing you how, whether it's Old Mutual, it doesn't matter. Who you go to, they will all agree tax-free savings is better than taxed savings. But be wary, though, that you can obviously only save a maximum of 3,000 Rand a month or 36,000 a year, or you'll end up paying 40% tax as a tax penalty. So if you're looking to grow your money, to grow your wealth, if you're looking for that financial independence one day, if you're looking for that second passport, if you're looking to build up that property portfolio, you're not going to do that saving 3,000 Rand a month. So you're going to end up having to go to a different solution, which is then going to be taxed at a very high rate. Why do that when there are alternatives and options available for expats living abroad? Alan Gray 2, why a tax-free saving may not actually be the best thing for you. Again, particular if you're going to go to more than that 3,000 a month. So let's look at how tax then affects your growth. We've said it needs to grow by 1.3% more at 18%. That's the EAC, or it needs to grow by the 2% or 2.6% if it's being taxed at 30%. Now, let's say we're saving that 8,700 Rand or $500, and we're doing that for the next 15 years. It means then that if you're not paying taxes, your money will have grown to roughly 940,000. However, if you're paying tax at 18%, because of how that tax is deducted along the way, you'll only get to 700,000. Or if you're paying tax in a fixed rate of 30% because you've got an endowment, you're only going to end up with 600,000. 600,000 or 700,000 is considerably less than 700,000. So which would you go for? Do you want that 900, or are you okay with getting just 700 or 600? You'd be surprised how many people, they want the 900, but they'll still send their money back home and set up the investments where they end up having to pay the taxes here. What that means from a cost perspective is that you've lost out on 200,000 in terms of growth, or 300,000. That is 22% less or 35% less money than someone who would have saved their money where they're not paying taxes. So remember that 22% down or 35% down. And you might think that as it comes down, it's fine. But what goes down needs to come up even more. So if you're going to do that and then suddenly make that money try and grow more later on, think about it this way. Let's say you have 100 Rand and it drops 10%. Simple as that. If it goes back up by 10%, you're not going to be back where you were yesterday. 100 Rand minus 10% is that light blue line. It is 90 Rand. 90 Rand plus 10% is 99 Rand, not 100 Rand. So what that means is even though they both drop 10%, you need to grow by just over 11% to get back to where you were. Let's look at it from a tax perspective, that lowest tax bracket. You've got 100 Rands worth of growth. Your investment grew by 100 Rand. The government took off 18% in terms of tax. It dropped down to 82 Rand. It now grows again at that same level. You're still not back where you used to be. You actually need to grow by 22% to make up that 18% that was deducted for tax. So let's have a look at a lump sum or at a larger investment. Let's say you've got 100,000 Rand. On day one, you invest that 100,000. It grows at 10% every year. So in year one, it grows to 110,000. You pay your 20% dividends withholding tax. In year two, that 108,000 grows to 118. You pay your 20% dividends withholding tax. It grows to 128. You pay your tax. It grows to 138. You pay your tax. It means then that in 4 years, you have 136,000. If it grows at 10% every year and you invest in the stock exchange, paying 20% dividends withholding tax. That same investment in a tax-free scenario, in year one, it grows from 100 to 110,000. No tax gets deducted. It then grows to 121,000, then to 133, then to 146. So as you can see, over just a short period of time, the difference because of tax is quite significant. So let's look at that over a longer period of time. You'll see the difference in tax from year one, so not too much. I'm paying 2,000 Rand tax. But by year four, you're paying 2,500. So let's have a look at that over an even longer period of time. Let's look at it in 10 years. In 10 years, you're paying 2,000 tax, same as last time. But now by year 10, because of that growth in the investment and the investment growth itself, you are now paying nearly 4,000 Rand in terms of taxes, double in taxes what you were paying in year one. So the cost grows significantly. It's 99.9% more. The gap gets wider and wider and wider. So remember that before and after tax, we lost, we got 22% less at 18% tax, and we got roughly 35% less at that 30% tax. We were going to get either 900,000, 700,000, or 600,000. Another way of looking at, if we want to simplify things, is saying how much less you're going to get. Let's look at how much more do you need to make up. Again, just to make up that 200,000 or to make up that 300,000 in terms of difference, your investment needs to grow by 28% more than a tax-free investment. Or your investment needs to grow by 56% more, that endowment, to be able to compete with a investment abroad, which is free of tax. So tax as a cost, it's a big question. Now comes the way that fees are charged. So very simply, if we summarize where we are till now, there are lots of different costs. One of the bigger costs that's very often unseen, that is not within quotes, is the effect of tax as a cost on your investment. Now, let's move past taxation and let's move at actual product fees, the actual fees within those quotes. Now, you get two different ways, essentially, or two of the broadest ways at fees. One is that where companies charge a fee based on the value of the investment fund. So for example, in year one, if you've got $1,000, the fee is based on 1,000. In year two, if you've got 2,000, it's based on 2,000. In year five, if it's 5,000, well, now it's based on 5,000. In year 10, if it's 10,000, now that fee is based on 10,000. So you can see that that fee goes up and up and up, and it goes up quite substantially as your investment grows. But you get other companies and other methods of fees, which are based on a period of time, a fixed period of time. Very often, some of those are 1 year, 18 months, or 2 years, but the fee isn't based on how much your investment is worth. The fee is based on the first year or the first 2 years of the investment. So what is the difference there? How do we compare those two? And this is often what you'll find internationally, comparing international solutions compared to South Africa. South Africa is very much that 3-in-1, that 3% upfront on lump sums plus 1% for life. Very different to the international side of things. Very often your international on lump sums, for example, will be 1%, but for 10 years and then it stops. So if you have an investment for 20 years, in an international structure, it would cost you 10%, 1% for 10 years. In a South African sort of structure, it would cost you that 3% upfront plus 1% for life. So over 20 years, it's 20% plus 3. So now we're looking at 23%. So a very, very different way of looking at costs. But let's look at it now from a more detailed perspective. Let's say in year one, and we're going to look at it now based on that regular savings, that quotations that I used earlier, that saving $500 a month or $8,700 a month for, I did it for myself for financial independence, for retirement, building up that nest egg, to do whatever I want to with it, in 15 years time. But what would the differences be in the fees? Now, if we look at that period base, that light blue line, you'll find that the fees start off, they grow during the first 2 years, as the investment grows during the first 2 years, and then from year 2, it seems to be relatively level. So why? Because the fee is based on the investment, on how much I've saved within that first 2 years only. So not a massive change as we go. Now let's compare that to a fee which is going to grow based on the fund value. Now, before I do that, let me ask you a quick question. The two fees I've used here, the one is 4.5%. That's what I've used for that light blue line, charging a fee of 4.5% on a fixed period of time, just that first 2 years. The other fee that I've used now is charging a fee of 3.65%. So something that's slightly cheaper. I think it's 0.6 or something cheaper, or 0.8 cheaper. So which do you think is going to give you the most value for money? Which do you think is going to work out cheaper for you over time? The more expensive, but based on a fixed period fee, or the much cheaper, but is based on the value of your investment fee? So let's have a look at that. The dark blue line, as shows us the costs, starts off, as you can see, quite a bit cheaper. In year one, it's only 1,200 versus the 2,500. In year two, it's also half the price, that more expensive way of charging, at 4,000 Rand versus 8,000 Rand using that fixed period of time. But what happens as we reach year four? Year four, they seem to reach a similar level. And then after that, year five, after 10 years, you'll find, for example, that if we compare it here, having fees based on a period of time is 3 times cheaper than having your fee cheaper, but based on the value of your investment as it grows. By year 15, for example, it's nearly 5 times more expensive. By year 20, it's considerably that gap. Imagine you're in your late 20s or early 30s and you're putting money towards your retirement or a financial nest egg. To have something that's going to cost you, for example, in 20 years when you are 50, 80,000 versus only costing you 14,000. So which is cheaper, that 4.5% on that fixed period of time, or that cheaper investment at 3.65%, but goes up based on the fund value? And this is where comparing costs becomes very complicated, because it's not just looking at the apple is 4.50 and the orange is 3.65 Rand. How are those fees going to be charged? Over what period of time? Is it based on, the size of the apple as the apple grows, or the apple tree, or is it based, there's a lot when it comes to comparing those two and understanding those two. Like I like to tell many people, it all boils down to cake. Very simply, if you're going to, let's say you're having a bake sale, like I recently had for my daughter. So you're going to buy a slice of cake and you're going to sell it again to try and make a bit of profit, to raise funds for the school. Where are you going to make the most amount of profit? On the cake that costs you 10 Rand a slice? Or the cake that is, remember, 43% more expensive? Or the cake that's 105% more expensive? Or the cake that is 164% more expensive? And why is it more expensive? Well, because there was tax involved, and the reduction in yield was much higher. So hopefully I've made costs, or I've tried to find a way that makes costs easier. Basic principle is you need to be able to compare costs, look at the different systems of costing, and look at that hidden cost that you don't see, and that is tax. How will that affect you? And if you're saving more than 3,000 Rand a month, you cannot do it through a tax-free savings. And the only other option back home is going to be a retirement annuity, where that money is then fixed until age 55. And I'm sure for many, you want that money more accessible. Then there's also the non-cost related pros and cons, the political security, access to global funds, your reinsurance or your government-backed investor protection, having to be able to save money directly in a currency that's not losing value. So there are a lot more than just costs, but have a look at those costs. Now, one thing that I would like to, before finishing, just reiterate when it comes to clients out there is get expert advice. Costs are very difficult to be able to compare. So get expert advice, not an opinion. As my wife told me the other day, and I put it in here, opinions are like cell phones. Everyone has one. And she is certainly correct when it comes to that. No matter who you speak to, someone has an opinion. So what is expert advice? Expert advice is given by someone who has studied that subject thoroughly, who is very highly skilled in that particular job. An expert is someone with extensive knowledge, the ability based on research, experience, and his occupation, and in a particular area or field of study. So as a South African living abroad and earning an income in a lower tax jurisdiction and earning that in a foreign currency with different options available to you, you need to make sure that you're getting expert advice from someone who is internationally qualified, not only qualified back home in South Africa, someone with recognized international qualifications in both financial as well as preferably tax and investment. Not someone with an entry-level NQF qualification, someone who finished matric and did a short course in something and now they're giving advice. Someone who has the international perspective and understanding, not someone who is SA-centric, SA resident, has lived in South Africa all their life, done investments inside South Africa all their life. They're generous, they can do car insurance, life insurance, funeral policies, set up your retirement savings as well as your investments, but has no financial qualification other than a short course. Someone with experience, international experience, first-hand experience of life challenges as an expat, understands what the requirements are of an expat. And life as an expat is very different to life as a regular person living back home. Things happen, things change, and you need solutions which can suit that. Someone who's highly skilled, someone with a long track record, with solid reviews and able to navigate the nuances based on you as someone who's living abroad, a specialist in their field. And this is very important. Someone who advises other South Africans, does webinars, educates others, is not a generalist. Again, not someone who does investments and funeral cover and life insurance and disability insurance and all sorts of other things. But, do you want a specialist? Or do you want a generalist? Think of it, I like to say in terms of, imagine you're not feeling well. You have a serious chest pain or pain in your chest. Are you going to go to the cardiologist who's a specialist? Or are you going to ask your friend who you know very well and he lives back home? You've known him for so many years. He used to be a teacher or he used to be a mechanic, but he did a short course and he's now, he did some first aid at the local fire station, and now he's advising everyone in terms of medicine. Go to a specialist. The other side of it is, when it comes to advice, you get two types of advice. Not only just specialist or generalist, but you get independent advice versus financial advice, tied financial advice. And why is independent very important? Very simply, it's being able to give you what I have versus giving you what you want and what you need. Let's say you want to buy a car. I've thought very long and hard for these analogies to make it easier for everyone to understand. Let's say you want to buy a car because you like camping. You often go on gravel and through the odd sort of ravine, not far deep, maybe something that's just 30 or 40 centimeters deep. So not, you're not going through rivers, but you're going to be going over rocks and hills and bad gravel roads. And I know from my own experience, yeah, I had a bad experience in terms of a gravel road. My car is not a 4x4. It's not designed to be a 4x4. Anyhow, but you want a car to go camping with, something that can go off-road, that can go on gravel and handles well, something you can put all the camping gear on and you go step into the local Mazda dealership. Now, I can almost 100% guarantee or assure you that if you're going to go to Mazda and tell them you would like a car because you want to go camping, this is their crossover SUV sort of range, they will sell you something. And they will tell you just how great one of these cars are. I'm certain of it. I'm sure they are good. They're not going to tell you, sorry, Tom, or sorry, Sarah, but wouldn't you rather go to Land Rover because they have cars specifically built for camping and off-roading? Or wouldn't you rather go to Toyota? Or wouldn't you rather go to Suzuki? Or wouldn't you rather go to, I don't know, I'm not a 4x4 sort of person. But wouldn't you rather go to a place that sells those kinds of vehicles? No, they will sell you what they have. And they will do a very good job in terms of telling you all the pros and cons and benefits. But is that really what you want? So is that advisor going to sell you or going to advise you something that he knows you need, but he can't give you? Or is he going to try and talk you into what he has? An independent financial advisor and a tied advisor may look alike, but under the skin, they are very, very different. They are as different as chalk and cheese. An independent financial advisor has no ties with any financial providers that can influence his decision to recommend a particular product. So he's not going to give you product A because that's the company that he works for, because there's a reason for recommending company A that's not in your best interest, but because there's something else involved. Independence means having the choice to give you any financial product that suits your needs without any restrictions. So giving you what you need. Now, living in China or living in Korea or living in Thailand or living in Vietnam, what are your needs? What are your tax circumstances? What is it that you want to be able to achieve? And finding the solution that will do that for you. A tied advisor is exactly what it says. He is tied to that particular company. He is employed by that company to give only that company's products and to give advice on only that company's products. He or she is also very often only trained in terms of that company's products. So does that difference matter? Yes, it does. Because as I said earlier, training standards will often differ between two. Financial advisors, for example, hold qualifications usually in finance and work within a very highly regulated framework. But an independent financial advisor is someone who's more likely to have a much broader knowledge because of experience and qualifications to be able to offer solutions from a much wider market than just a tied financial advisor. So what does this mean to you? Unsurprisingly, if a client approaching a financial advisor expects the best advice to suit their personal circumstances, A tied advisor should ideally tell you, look, I only work for company A. I can only give you company A's products. However, there are other companies that will be able to offer you better solutions. I find it unlikely that someone will actually do that. Whereas an independent advisor should offer you advice that you can choose from more than one company by more than one provider. So comparing the two, going to a tied financial advisor is like going to someone who works for a bank. And you will only be receiving advice on products offered by that bank, no other bank. While going to an independent financial advisor is like visiting a comparison website where you're getting quotes from all the different banks. So hopefully you found that was enlightening. I've tried to make the costs, as I said earlier, it's a very complicated subject. There are a lot of different types of fees and ways of charging fees. So I've tried to narrow that down using the most common ones to try and give you a basic understanding. However, before looking at any financial instruments or investments, one needs to be able to sit down with an expert who understands both to be able to go through the pros and cons, the actual costs, how those costs affect you. And what those costs actually are. I'm a group expert on many of your foreign expat groups. You will see if you'd like to reach out. I am available on WeChat as well as Kakao Talk and WhatsApp. I'm going to launch a poll. That poll, essentially, if you wouldn't mind taking part, allows me to gauge who my clients are on the webinars, how long they've been in Asia, why they've gone to Asia, and it helps me to plan future webinars on topics that then are more suited to the type of client that watches these webinars. And then just a disclaimer, while we do strive to ensure that obviously everything is accurate as possible and that it is relevant in the content, regulations and laws do change and individual circumstances may vary. So you do need to seek professional advice tailored to your specific situation based on where you are, what you want to be able to achieve before making any kinds of investment decisions or doing anything. And then obviously we accept no liability for actions taken based on this information within the webinar, because like I said, it's such a generous thing. It's not to your specific needs and location. Right, I'm going to open up, if you wouldn't mind taking part in that poll. There are not a lot of questions. I think there's literally only 8 questions. It just helps me to determine where clients are, their sort of background within Asia, and allow me to plan future webinars to make it better suited for advice. I thank everyone for their time here today. I have tried to make this webinar a little easier. The feedback I've been given from some other webinars is that it's still too technical in nature and still too much jargon. So I do apologize if this one has been the same, but it's not the easiest of concepts to try and convey. But also it's one of those concepts that I get asked for most often by people. What are the costs? How do they compare? And as you would have seen from this, it's not that simple. There are quite a few different ways to evaluate costs and different ways of charging costs. Right, I'm going to stop the screen or the sharing just so that people can actually see me. And then let me see, I've either done a very good job or I've done an horrific job, because I see there are no actual questions today, which is quite unusual. Usually there are a lot of different questions in the Q&A. I do thank everyone for your time. I really do appreciate it. I will be doing the webinar again on Thursday at 8 p.m. Chinese time, 9 p.m. South Korean time. So if you're in Vietnam, that's also 8 p.m. If you've missed the first half of this, you're welcome to ask. There are links available that you can use. I see there is one question. I'm trying to see. It says there's no unanswered questions though. Let me see if I can find out. let me see, do you, I don't want to mention names, but I have someone with their hand up. You should be able to type the questions in the question box if you have a question, or in the chat box. If not, do reach out to me and I will answer your questions in person. Thank you everyone for your time. I do hope it was worthwhile, and I look forward to seeing everyone in my future webinars. Thank you. Bye.